Next, problem 18. During the previous year ending 31st March 2019, Mr. J, resident, sold the following assets. So the assets, shares, unlisted, agriculture land in rural area, outside municipal units, personal car, agriculture land in urban area. So the shares unlisted has been sold on date 10/4/2018 for rupees 15 lakh 50,000, and the cost of acquisition is rupees 1,70,000, and the year of purchase is 2009-10. FMV on 1/4/2001 is nil. Agriculture land in rural area. So as per section 2 of 14, any agriculture land which has been situated in the rural area, it is not a capital asset. So we are not going to calculate any capital gain for the agriculture land in rural area. Third asset, personal car. So any movable property which has been used by the assessee for his own purpose or personal purpose, then such asset will not be a capital asset as per section 2 of 14. So again, for the personal car, we are not going to calculate any income from capital gain. Fourth asset, agriculture land in urban area. So the urban area, so the rate of sale is 10/6/2018. Sale proceed 30 lakhs. Cost of acquisition 2,50,000. Date of purchase is 79/80, that is before 1/4/2001. So FMV 2 lakh rupees. Next, on March 31st, 2019, Mr. J purchases another agriculture land for rupees 95,000. Now, the assessee has sold the agriculture land which is situated in the urban area, and after that, he has purchased the new agriculture land for rupees 95,000. We can claim the exemption under section 54B. And most of the students will get confused whether we need to claim the exemption for agriculture land in rural area or agriculture land in urban area. So the section 54B has clearly stated that the agriculture land which has been situated in the urban area has to be sold, and after selling that asset within the period of 2 years from the date of transfer, the assessee has to purchase new agricultural land either in the rural area or the urban area. So this exemption can be claimed for the agriculture land in urban area. Next, the CII of 1 and 2 financial year is 100, 9 and 10, 148, 18 and 19, 280 rupees. Find out the capital gain chargeable to tax for the assessment year 1920. Next, read on the heading, calculation of taxable income from capital gain. The first asset is shares unlisted. So the period of holding starts from purchase date and end on sale. So asset has been purchased on 2009 and 10 and sold on 10/4/2018. So since the asset is unlisted shares, it fall in the fourth category, that is, if the asset has been used for more than 2 years, it will be called as long-term capital asset. If it is used for less than 2 years, it will be called as short-term capital asset. So since the asset has been used for more than 2 years, it is a long-term capital asset. So take the gross sale consideration. The asset has been sold for rupees 15,50,000, which has been given in the problem. So the gross sale consideration is 15,50,000. Now from that, minus the realization expenses. So the realization expenses is nil. And the balance amount, net sale consideration is 15,50,000. Now from that, minus the index cost of acquisition. So the formula, cost of acquisition divided by CII of purchase year into CII of transfer year. So the CI value, since the asset has been purchased after 1/4/2001, so the purchase price will be the cost of acquisition. So the purchase price is 1,70,000. So the cost of acquisition is 1,70,000, and the asset has been purchased in the financial year 9 and 10. The CI value is 148 rupees. 148 into 280, that is the previous year CI value which has been asset sold. So the value index cost of acquisition is 3,21,622 rupees. And there is no any additions given in the problem. So index cost of improvement will be taken as nil. So the balance amount 12,38,378 will be the gross capital gain. From that, claim any exemption. No exemption information. It has been taken as nil. So the balance amount, that is 12,38,378, will be the taxable long-term capital gain. Second, we have the asset called as agricultural land, which is situated in the rural area. We are not going to calculate any income from capital gain on the agricultural land in rural area because it is not a capital asset as per section 2 of 14. So income will be nil. Next, we have the third asset, that is personal car. So any movable asset which has been used by the assessee for his personal purpose, it is also not a capital asset as per section 2 of 14. Next, we have the fourth asset, that is agriculture land which has been situated in the urban area. To calculate the period of holding, that is purchase date and end on sale date. So the asset has been purchased on 7980 financial year and end on, that is sale date 10/6/2018. So the land will fall in the fourth category. So more than 2 years, long-term capital asset; less than 2 years, short-term capital asset. So it has been used for more than 2 years, it is a long-term capital asset. Next, take the gross sale consideration. So the gross sale consideration is rupees 30 lakhs, and from that minus the realization expenses. There is no any realization expenses or transfer expenses, so we have taken as nil. So the balance amount 30 lakh is the net sale consideration. Now from that minus the index cost of acquisition. So the formula, cost of acquisition divided by CII of purchase year into CII of transfer year. So first calculate the cost of acquisition. So since the asset has been purchased before 1/4/2001, that is 7980, before 1/4/2001, so the cost of acquisition will be purchase price or FMB as on 1/4/2001, whichever is highest. So if you check the problem, so the asset has been purchased for the value of rupees 2,50,000 and the FMB as on 1/4/2001 is 2 lakh rupees. 2 lakh rupees. To take the value 2,50,000 or 2 lakh, whichever is highest. So the highest value is 2,50,000 divided by CII of purchase year. So the asset has been purchased before 1/4/2001. So the CI value will be taken as 100 into transfer, that is previous year, 280 rupees is the CI value. So get the value 7 lakh as an index cost of acquisition. And there is no information for improvement. Index cost of improvement has been taken as nil. So the balance amount 23 lakhs is the gross capital gain. And if you observe the problem, they have purchased the, or the assessee has purchased the new agricultural land for rupees 95,000. So he is eligible to claim the exemption under section 54B. That is, if he is selling the if he is selling the old agricultural land which has been situated in the urban area, and within the period of 2 years from the date of sale, you need to purchase the new agricultural land either in the rural area or in the urban area. You can claim the exemption under section 54B. So exemption under section 54B So exemption amount, that is gross capital gain, or cost of new asset, that is new agricultural land asset, plus amount deposited in the capital gain account scheme, whichever is less. So the gross capital gain is 23 lakh, or the cost of new asset is 95,000, and they are not given any information called as amount deposited in the capital gain account scheme. So the lowest value is 95,000 as claimed as exemption. And the balance amount 22 lakh 5,000 is the taxable long term income.